So on that note, I'd like to bring up Angela Vidakovich from Brookfield. I've known Angela for many years, and I was just so delighted to have her agree to this. She originally wasn't available, but I thought that having seen her moderate so many times that she would be ideal for this panel, and I want to welcome her up now. Thanks.
Well, thank you, Karen. And what Karen doesn't know is I spent the last 3 days at presentation training, some really intense stuff. And anyways, how many people here golf, ski, or do anything where they have a lot of, or they've taken lessons, and you come back and you think, how do I golf? How do I hit the ball? How do I hold the racket? So anyways, I do all of those sports, but not very well. So I'm Angela Vidakovich. I work for Brookfield, and I work in the public markets group. It's a group that a lot of people don't know that Brookfield has, but we are growing quite a lot. We are now about $225 billion in assets under management and about $17 billion in the group that I work in. And I market REIT strategies across the country and listed infrastructure, so all relating to real assets. So now more of a derivative of real estate. When I first started in real estate, and I won't say how long that was ago, but the REIT market was very nascent, and there actually is a big, $1.4 trillion universe out there of REIT investments. And if anybody has kids coming out of school and they want to learn a lot and get really tough, go into commercial real estate as a broker. So then I moved on, had a whole different stints, went to UBS Global Asset Management, and along with Tom Johnson, who I think is still here, we launched a fund-to-fund of real estate for the Canadian market, and now I've been at Brookfield for close to 7 years. So enough about me, but so another thing we learned in this presentation training, it comes down to 60-30-10. And that rule is 60% of your presentation is your presence and just taking control of the room. The next 30% is your voice, and the last 10% is content. Well, I've got 3 great speakers here who have great presence, they've got great voices, and they are outstanding on the content, so I'm sure it's going to be excellent. But they come from very differing backgrounds in the real estate world. So I'm going to start out with Frank, and Frank Lonardelli. He is a developer focusing in the Calgary market on, special multi-use retail development. His company's called Arlington Arlington Street Investments. That's apparently where he grew up. And he's going to talk a lot about what he's doing, what the opportunities are in that part of the market. I have Rob Goodhall, who's been in the real estate community here for I think as long as me now. But and he works for a company called Canadian Mortgage Capital Corporation. They have really 2 divisions. One is called Atrium, which is listed on the TSX and has done extremely well, and another is raising private equity type fund vehicles for real estate investing across the country. Thirdly, I have Ali Khan here. He's here from Miami. He's also originally from Canada, the nice part, Vancouver, and he works for a group called Turnberry Associates, which is focuses a lot on luxury real estate, so recreational, hotel, et cetera. An example would be the Fontainebleau Hotel. I don't know if everybody probably remembers that from Scarface, but it's now been redone. It's a fantastic conference facility in Miami. And so they bring very different perspectives here, and because of that, we're not going to ask a lot of questions, so we're going to bring it down to that rule of 3, and I'm going to have them elaborate a lot on some of the key areas of real estate. So 1, why does everybody want real estate? Or there's kind of 3 promises: yield, capital preservation, and diversification, so that in your portfolio you can mitigate volatility. And we all aim and strive for that. It's easier said than done, and real estate's very broad and diverse, and there's many ways to get at those objectives. So I'm going to start out I've introduced the three panelists. We've got some questions, and why don't we go to the first one? It gets back to that old location, location, location. And I'm going to start out with Frank. So from your perspective, and I know what that is, where do you see some great opportunities in terms of sector of real estate and the geography?
Right. Well, I think Karen wanted to be provocative, so she brought someone from Alberta to talk about real estate. So that's an interesting start. But I think, in general terms, I think you can make money anytime, anywhere in real estate if you deploy the appropriate strategy. And so geographical picking is one part of strategy. So is timing, and so is crystal ball gazing, okay? So marketing from a strategy perspective, strategy beats timing 10 times out of 10. So in general terms, if you think about a geography, the fundamentals have to apply, right? So what are the fundamentals? You have to have a robust economy. You got to have positive in-migration. You got to have a young demographic, a positive tax regime for business. And the two things I'd suggest to you that you really want as well is you want a young demographic. And ideally, you want the third largest energy reserves on the planet. So let's get a bit provocative here. I just described Alberta 12 months ago, okay? So when we think about geography, one of the things that's interesting is when you talk about picking geography and picking geography during certain timings, you've got to ask what happened to a market. So let's think about what happened to Alberta. One thing and one thing only happened to Alberta. But general terms are that the foundation, the fundamentals remain the same. So what's the three things that happened? Does everyone know? Most people would say it's energy, right? It's not. It's geopolitics. Internationally, nationally, and locally. So let's think about that for a second. So internationally, OPEC turned on the taps as a response to trying to weed out the high-cost energy producers. And that was in response to the United States jumping up and down and claiming energy independence because of shale gas production. If anybody understands shale gas production comes on like a lion and comes off like a pussycat. So if you're in energy, you realize that shale gas has very thin life reserves, okay? It was also a response to America going into Iran and doing the treaty, which unfortunately put another 3 million barrels on the grid. So we have a supply glut of energy. I believe that that's all going to play out because of one reason, that it always plays out time after time, and that's greed. We still have to make money producing energy. In Canada, we've got a very interesting circumstance, right? We're talking about 1970s and 1980s politics, East versus West happening again, all right? So we understand in Canada that we don't have an energy production issue. We have an energy distribution issue. So what just took place? The Energy East pipeline just got shut down by Ottawa. And it's quite interesting if you think about that, because the big claim around Energy East pipeline being shut down was about environmental concerns. If you actually do the research, you'll realize the greatest, easiest, and most efficient, safe form of transportation for energy is pipelines. And who is talking about pipelines? A municipal politician who is a mayor who has no stake in the game, Denis Cogier from Montreal. It's quite interesting because when he was talking about the issues around pipelines, he was pumping 50 million liters of raw sewage into the St. Lawrence Seaway. So we've got some very interesting politics happening. The other thing I find interesting about what's happening in Canada, and I want everyone to be clear about this, is that we don't have an issue in Alberta with energy. We have an issue in Canada. This is a Canadian problem. And so Justin Trudeau, one of his big moves as soon as he got into government was to bail out Bombardier for the third time to the tune of $1 billion for a company that has 5,000 employees. Think about that for a second. The province of Alberta has lost 150,000 to 200,000 direct energy-related jobs, and the government's considering whether or not to give them a bailout of $250 million. So I'm telling you that I know rationale will prevail and all these things will play through. And the last little fun anecdote is that in Alberta we have a one-term NDP party, and they will come and go in the next 2 years. So what I'm saying to you is that asking the question about geography is but one portion of strategy. And I'm saying that one of the things we think about at Arlington Street, and I think one of the things that people always think about, is when do you want to get into the game? And I'll flip it over to my friend Rob by making this last comment. If you think about Alberta being at the precipice of a news cycle, which I think we're at the precipice of a new cycle. And I don't know if it's 6 months, 12 months, or 24 months out, but we were definitely at the precipice of a new cycle. Where do you think we are in terms of a cycle in Ontario and in British Columbia? And I would say to you that if we're not at the second or third period of the game, we're in overtime. That's my thoughts.
Okay. Thank you. So over to you, Rob. Now that you focus on a lot of different parts of the country, so it'd be interesting to hear your perspective.
So like Frank, we just covered Canada. We cover primarily Ontario West, where the demographics we feel are best and where the long-term economic prospects are best. Right now, we're focusing on BC and Alberta, which have the best job growth, the best GMP growth, and where we feel the real estate markets remain very strong. We're staying away from high-end real estate in those markets because we think they're vulnerable, particularly in Vancouver, where the single detached market is sort of gone crazy. In terms of the types of real estate we focus on, we like multi-residential, particularly low-rise townhouses in both those markets. And if you can find affordable product in Vancouver, it will sell incredibly well. And we also like urban retail, which is really just a play on the densification of the downtowns. We've done 3 deals recently in Toronto, downtown Toronto, on King Street West and Queen Street West. And those rents are literally jumping. And you can't say that generally about the retail market, but you can say that about urban retail. Recently, we saw rents jump from $25 to $75. That shows you the amount of condominiums that are being built and the amount of traffic increase that is going on in that area. So those are the 2 areas we like.
Okay, and over to you, Ali. Now we're going to take more of a North American perspective
Sure.
as well.
I'm obviously a bit of an outlier at the table, and appreciate the candid conversation. But the company I'm with is a private North American but U.S.-based developer and operator of assets. So a bit of a hybrid. We're a family company, and then we're owned by 2 siblings, second generation. But we've got 4,500 employees and operate all of our own assets. So I wear different hats during the day, and so a lot of the conversations that I heard in this room, which I appreciate, resonated. Duration, term, scalability, cost of implementation, et cetera. But to answer your question, I'm going to just use the examples of what we've done in the last 12 months because we sort of put our money where our mouth is. A lot of our growth in the States has been organic. We've focused as well on a core population, a younger population, markets where there's political support, similar to what you're saying, but also where we think there's a long-term horizon of growth, some sort of a tax benefit, some sort of a transportation or conference center expansion, and some sort of ability to get capital to pay attention to those markets. So in the last 12 months, we bought a 3.8-acre site in downtown Nashville, Tennessee. First time I went to Nashville was 2.5 years ago. I don't know if anyone's been there. Fantastic city, growing young population, great tax benefits, great convention center. So we bought the site, Main and Main, 8th and Demumbrian, from the Methodist Church, who interviewed a Muslim Canadian kid representing a Jewish company to come into Nashville and buy a 3rd-generation piece of property from the Methodists. And for whatever reason, they gave us the land. So we are building a 530-key JW Marriott, 8th and Demumbrian in Nashville, right by the convention center, for all the reasons you just talked about. We also worked with Related New York and focused a lot on Boston. Related Beal has a really big focus on a few blocks in the Boston area, and they pieced out a piece of land that has a multifamily or a cost-controlled multifamily component and hotel aspect. So they could monetize the tax credits, and we could work the hotels. So we joined in, and we're doing a $102 million, 150-key Courtyard by Marriott Hotel, which will be the most expensive courtyard I've ever done in my life, and hopefully the last courtyard I ever do at that price point. But the reason we liked it is TD Gardens. We like Boston a lot. Again, it's a growing demographic, very limited scope on land and entitlements, and great ability to finance and capitalize these. Our last project, which builds on the same theme, is we bought February of last year with Richard Lefrac's team out of New York. They controlled 190 acres in Florida, but north of Miami Beach, south of Aventura, on the east side by the bay. So you've got 95 on the west, you've got the water on the east, great growing market on the north, and Miami Beach, which has just been on fire for the last 5 years on the south. And we managed to sort of finagle a 190-acre parcel of land, which is a generational play for us, where we're going to build a school, active shopping, multifamily, rental buildings, and some condo buildings. So all organic, all within markets we knew or had a presence, all off-market effectively, but with the view that in the long run, with the growing population and ability to service that, we should be able to unlock some value.
Okay. So before we move to the next question, I thought I'd change it up a little bit and see if there were any questions just on that point, any areas of interest that anybody had in terms of where and by sector, how to invest. No? I want this one back there. Go ahead.
I had a question for the guy about Alberta. Why do you think in the next 2 years it's going to be turning around? Like, is it a view on oil? Or what is it your view that makes you believe that Alberta is going to turn around and go back up again?
Yeah, the guy's name's Frank. That's okay. That's okay. We'll get to know each other after for a cocktail. What I was referring to was market timing and fundamentals. And so what I'd said was my thesis is that all the fundamentals that you look at when you're investing into a geography remain in Alberta. One of the things that doesn't exist in Alberta is political sway, internationally, nationally, and locally. And what I'm saying is that if you're placing your capital, listen, there's a lot of guys who go, or girls, excuse me, who go into one-trick pony towns, like a mining town, and hope that that one thing happens. I'm saying that Alberta still has the Alberta advantage, and I said in time what'll take place is it'll be a place where money is attracted to it again because of its progressive business environment and all the other fundamentals I was suggesting. I'm certainly telling you that if you look at positioning capital, I'd say you're going to be early if you position capital there today. We'll talk about where specifically down the road, I think, with some questions. But I think you're not going to lose if you're putting capital into Alberta today if you're thinking about a 5 to 10 year horizon.
Okay, thank you. So let's move on to our next one. There's various ways to invest in real estate. You can invest directly, you can invest in funds, you can invest in the public markets. So I'm going to ask each of the panelists, starting with Ali, to address, some ways for high net worth and family office investors to access, very good real estate investments.
So I don't want anyone to think that I didn't read the questions before this session today, because I did, but my thought again is because I'm a bit of an outlier, I'll answer them again with some of the actions we took in the hopes that I can give you some insight about the US markets. Basically, over the last three and a half years, what we found the greatest displacement was because we already had a fairly substantial real estate portfolio, was to actually go back into the capital markets and restructure all of our debt or equity positions. And the reason we were excited was we sort of made a really long bet on interest rates being low, and the US markets at the time were being fairly flush with capital. So maybe three and a half years ago, we actually did a roadshow where we went with. We're a fairly private company in a sense that we don't normally like to have, although we have sexy assets, we don't normally like to have a lot of publicity, but we actually did a roadshow for several weeks, traveled the country, met with a lot of banks and rekindled relationships, and really tried to access that low-cost, long-term paper, which is sort of all of our holy grail in real estate, because we felt that it was out there, and we're successful in doing so. So what we did is recapitalized all of our assets because we thought that was the most lucrative opportunity. We knew the asset, we knew the real estate, we controlled it already, and so we effectively did some $4 billion of refinancing, primarily with balance sheet and securitized lenders. A lot of it was non-recourse, given that it was a market that when you ask for certain things, people were trying to chase sponsor, as we talked about today, or chase asset or chase market, and so we were able to present that story. And we closed the last set of our deals March 9th of this year. And I think we all sort of came down off this crazy run, right? And I think we've made the right decision because now we've got low leverage, either low cost or long term, flexible leverage on pretty great assets that we're either expanding or repositioning with that capital, or just throwing off operating cash flow as a result.
Okay, so over to you, Rob. Just given the whole focus on yield, capital preservation, et cetera, what are the best ways for high net worth investors to access
Well, if you're going to go into the public markets, you're basically investing in REITs. They've had a wonderful 15-year run. They're low leverage, have very sustainable dividends. But I think the cap rates are probably as low as they're going to go. I think the public markets are seeing that, and that's why the REITs have had a bit of a rough go over the last 18 months, where prices have gone down. If you look at the vacancy rates of the four main commercial categories, apartments, retail, industrial, and office, all four of them are up in vacancy rates between 2014 and 2015. So going forward, I don't know what the prospects of the REITs are. They're trading at or below NAV. The question is, do the vacancy rates continue to increase or not? what we've done recently, and which seem to be generating very substantial yields, is creating a fund. And you really have two types of funds. You can have a fund where you're buying income-producing assets. It's almost like a private REIT. Or you can have a development fund like we run, where you're trying to get very high IRRs. And our last two funds have generated 21%, and the second one is tracking at 17% net of all management fees and expenses. So I wouldn't put all my money into a development fund, but it's a place where you can get superior yields.
Thank you. So over to you, Frank. I know you take a different approach and how you work with your investors, so it'd be interesting to share with the group.
Well, I think what Rob's comments were interesting, and Ali, of course, has the great fortune of being in the U.S. with non-recourse lenders. We don't have that in Canada. Sure. It's a very fundamental difference between this side of the 49th and that side of the 49th, and so it affords very different opportunities. I think Rob's absolutely right. I'm not a fan of REITs. I think that over the past 15 years, we've had accredited investors, ultra-high net worth investors, and family office invest in my company, directly invest into our projects. And this is quite interesting. You know, 15 years ago, I used to have the money manager who sat in front of the family office and would sit in front of me and say, you know, Frank, the family office business is not in the get-rich business. It's in the stay-rich business. I didn't really know what that meant, but it sounded good. So I said, okay, great. What does that really mean in terms of the capital? What they'd say is that of all the money that's in the family office business, if you think about asset allocation, we'll take 15 to 20% of that and put it into real estate. Of the 15 to 20%, we'll take 2 or 3% and put them into private deals like minor alleys. And what we've seen over the span of time is exactly what Rob talked about, which is a lot of the money that didn't go into private deals with good management teams and good project fundamentals went into the REIT business. And because REITs are pure plays, REITs are dead simple business models. There's not a whole heck of a lot of strategy behind them. So either the market's going for them or it's going against them. And if it goes against them, it's very hard to mitigate. So over 10 years, a lot of the REITs have pulled back. A few of the REITs, have dramatically pulled back. And of course, most of that institutional money was attracted because of what? This magical word called yield. Well, yield, ladies and gentlemen, doesn't create wealth and it doesn't sustain wealth. The only thing that creates wealth and sustain wealth is a combination of yield and capital appreciation. And so what you're finding is guys pivoting. So Rob's company realizing they got to get into development. Why? Because pure play REITs don't work anymore. You got to have a portion of that money going into development so you can turbocharge that return profile, so you can compete against the inflationary issues, against inflation grading against the return profile. So no, I don't put any of our own personal capital into institutions. I love what guys like Rob do, but there's very few guys in the market who do what Rob do. And I think that placing capital directly into private companies that have great management teams and strong project fundamentals is where you get your best returns.
Okay,
Somebody
go ahead.
earlier on spoke a little bit about, I think they used a Blackstone example and a 15% yield on some of these REITs and other in the U.S. And as an individual who's lost deals or sold deals to those REITs, I completely agree. There's no way I would touch any of those because not the bounce that's going to be there, just knowing some of the assets that they've chased, the theory on our side is let it wash out because you may make a 5 or 6 or 7, you may. But in terms of the duration of the loss of capital or the potential further free fall, not to be a naysayer because we do deals, but it's something everyone needs to take into consideration as they make their allocations.
Thank you. Any questions from the audience on that point in the back there?
Speaking about investment, I'm curious to hear an American perspective on investing in Canada. I mean, now that the dollar has swung the way
Sure.
it has, and the stability of the Canadian market, generally speaking, especially in Ontario and some of the bigger city centers, are Americans looking north now and saying, hey, there's a great opportunity here now that Canada's on sale, the dollar's in a good position? Are you seeing that?
Yeah. The issue is on a currency side, the American consensus is still the U.S. currency is still a great currency to be in for the medium term, not even just the short term. So I'm here not only because of Karen and Amana, but because we should pay more attention to Canada. We've done a few shadow lending deals that we were talking about that were, to my frustration, they were friends and family deals. Somebody knocked on a door and we said, all right, let's go, and which to me sort of lacked discipline. But it's an interesting economy for that. It still doesn't feel that cheap, though, quite candidly. I mean, if we convert it to U.S. dollars, obviously everything feels cheaper, as we experienced at the restaurant we went to last night, where everyone, thought we were filthy rich for a moment. But it still doesn't feel that cheap. We're definitely paying attention. But so, look at London with the tax changes. Look at Spain, even though it's been coming back. So the U.S. market, the flight capital is pretty international. We can look at a lot of different things in the same day. We looked at Brazil. So Canada's, there's no, other than me being Canadian, there's no true affinity for Canada, other than the fact that there's displacement on currency and it's worth looking at. So all these issues you brought up, we're not necessarily aware of them, but we know the noise, and it scares us, quite frankly, to get involved, because the political climate is, with all the noise we have in the U.S., this political climate is still conservative. There are taxes, withholding tax issues, there's currency issues. It's not as easy to get into the real estate or get the dirt, and so we sometimes, either we're not intelligent enough or we don't have enough time to break through it.
But what is interesting is the last time I was out in Vancouver, the developers were talking about raising their launch prices on their condominiums or their townhouses because of the depreciation of the Canadian dollar.
Sure.
You don't hear that at all in Toronto.
That's interesting. Okay. Before
There's
we
some
move on.
interesting things in terms of a data point. There is a REIT in the marketplace right now that did a gray market private placement with BMO Capital Markets. Tried to vend out 22 buildings. Quite interesting. They did a very closed deal, only went to 20 different parties. We weren't one of them, but we were trying to sniff out the deal. We actually met with them over the last week or two. 22 buildings. The original fair market value on the strike price 8 years ago, was $920 million. They gave guidance at $550. They went to 20 different companies, 15 in Canada, 5 in the US. There was 2 bids, both in America. And the interesting part about it is the 2 bids came in when the dollar was at 70 cents.
Sure.
The dollar went to 74, bids came off the table. So I think Americans have a real hard time because of the facts of demographics, right? I mean, you got as many people that live in the state of California that live in our entire country. So they fly over and look at this massive rock with not a lot of people and don't see a lot of upside. And I went to school in the States, and that is the disposition then, and it is the disposition today. I think you probably agree with that,
It's
Ali.
all about liquidity, right? At the end of the day, we buy or develop to a cap rate, and,
Right.
and you're assuming someone's going to buy you at a 4, 5, 6, 7, whatever cap rate justifies your yield. And
Right.
and it's difficult to get that comfort in the U.S. Like we said, we went on this road show. The number of people that came out of the woodwork on the road show to support these deals, nobody was talking about Nashville. We did 2 deals with Wells Fargo in Nashville. So all of a sudden, big lenders are saying, numbers look good, the dynamic is there. And so you're right, when we look at the Canadian market, if it's 55, 60% levered with some sort of recourse, we factor that in as a cost on our capital. So I'm saying maybe 60% levered, but with the recourse, I'm not walking away from it. So I want equity-like returns into your debt stack.
Right.
Makes it hard to underwrite something when we have other opportunities.
So do you find you like commercial less than multi-residential? Because with multi-residential, you pre-sale, your revenue is pretty well solid,
Sure.
and you don't have to worry about interest rates moving up while you're developing the way you do with commercial.
Sure.
Because cap rates are going to change if interest rates change.
Sure. I think, and this is our limitation because we're a Florida company, Florida had the similar pre-sale deposit use structure and obviously got smashed in 08 and 09. And I moved to Miami in 05, and secretaries were buying condos, and I should have picked it up when they're saying they have 3 condos and a taxi driver. And so although we like the pre-sale model because your equity screams, right? Like we talked about, 15% equity on with you deposits and debt, it's somewhat volatile too because
Well, it's interesting because in Canada, Toronto actually has by far the highest deposit levels
Sure.
in Canada, which is almost counterintuitive because it's probably the most developed, along with Vancouver, as a condominium market. But it's 20 to 25% cash deposits. Vancouver's close at probably 15 and normally 20. Alberta's 10, and it was 5.
Sure.
So we never went to high-rise condominiums in Alberta because we could not get comfortable with the amount of deposits. It's
also
pretty
'cause
hard to
you-
walk
'cause you
away
couldn't get
from
your
a 20
yield
to
as well that way too, right?
your yield looked terrific, but you didn't really know if people were going to close till the day
Sure.
of closing. Whereas if they've put down 25% cash or even 20% cash, that's a big loss for them not to close.
Sure.
And they're more than likely going to get bank financing. If you're only putting down 5%, you're not quite sure how that purchaser is going to finance the other 95%.
Sure.
Well, those are all really good points. I think we have, about 5 minutes, Karen? So why don't we just end on kind of the one last question? It's like, if I gave you a whole bunch of money tomorrow, where would you put it? So why don't we start with you, Ali?
Our mandate for 16 after this March 9th, which was our last transaction of the year, is we're not putting out any more capital for the balance of the year. Not that we're that dramatic or that disciplined, because I work for a high net worth guy that'll change his mind in the morning. But our mandate right now internally is we're just going to finish all the development deals, expansion deals, renovation deals we have. And I say that because the first 3 months of this year in the U.S. market was horrible from a debt and liquidity perspective. So people are shaking. People who thought maybe they can get something done maybe still be waiting and hanging out there. And we'd like to see what happens in 7 or 8 months. And also this election is really a lot of noise for all of us, and it's scaring us as to where it's going to go, especially as a family business. And so we think, let's not be greedy, let's wait and revisit towards the end of the year.
Sounds good. And Rob?
We're still comfortable with the GTA in Vancouver as long as it's affordable product. We did a deal recently in North Vancouver, 4-story wood condominium. Vancouver probably builds the best looking condominium projects in Canada. Their city approvals and design committees are much tougher. Toronto's actually learning from that. The average sales price on this condominium was $560 a foot, which is, by the way, about the average in the GTA, so not high. We looked at that and we thought this is going to sell in good times and bad. The truth of the matter is we're about to launch and the number is going to be about $625 a foot, still relatively affordable in that market. So those are not easy deals to find, but if you can find them, they're golden. And we feel the same way in Toronto. So we tend to be always in 416 for mid-rise. But for low-rise, we recently did a deal in Vaughan, a townhouse project, 200 towns, priced at under $700,000 a unit. That will sell all day long in good times and bad as well. So we're trying to play defense, but those two developments have yields, IRRs, projected IRRs of 21 and 27%. So you can still get terrific yields if you don't have too much money to try and put out. So our funds tend to be fairly small.
Okay, thank you. So lastly, Frank?
Yeah, I would give you my answer, but I'll make a comment about what Rob just said. I think it's interesting, the spec market in both those territories, Ontario and Vancouver. You know, the spec market, or the shadow market as we call it, in pre-selling condos used to be a 2-legged stool. Now it's a 3-legged stool. So the 2-legged stool used to be, guys or girls who'd be going out and buying units for cash flow, right? That was probably all of us at some point. And then the second stool was, guys or girls who are going to flip the product. Well, Vancouver's got a third stool, a third peg to that stool. And that is capital placement. So the Asian market is coming into Vancouver, buying units and not filling them. They don't want renters. They don't want anything. They want a safe haven. So there's now flippers, cash flow buyers, and safe haven purchasers. And so in Vancouver, I'm thinking what's going to happen politically is they're going to shut that down. Sure. And they have to, because of some very serious things that are happening in that marketplace, which if we had half an hour, I think you'd find fascinating. But my answer to your simple question is this. If we had a lot more money than we already have, we would be doing exactly the same thing that we're doing right now. And that is investing into the greatest market in the past century. And that's the market of urbanization. And so I would be buying anything in the urban setting, downtown, in the peripheries. We buy non-assembled, low-profile commercial buildings. We change the land use, assemble them, and build, live, work, and play towers for 2 demographics, for the millennials and for baby boomers, okay? I'm in between those 2 demographics, all right? And so that's what we would be doing, and that's what we would continue to do. And just a word to the wise that we think about all the time. No matter where you're placing your capital, whoever you're placing your capital with, you ought to be having the question that people should be thinking about, which is, how are you future-proofing your portfolio for the millennial generation? Millennials are changing everything about retail. And it doesn't matter if you're buying a car, you're buying clothes, or you're buying assets that we're building. They're changing the makeup of the units and the technology of the units, both on the rental side and the commercial side, on the condominium side. Commercial office is going to have the most dramatic shift in the next decade with the shared economy. So I really think no matter what sub-market you're going after, you really got to be asking the people how they're future-proofing their portfolios for the millennials.
Okay, so on that note, any other questions from the audience? Any question you'd like to ask? Different topic? Go ahead.
I would just say, we don't have a half an hour, but when you tease us by saying these changes that are coming in the Vancouver real estate market based on the foreign money, could you give us a few juicy?
Well, I'll give you the anecdote. So, and Ali knows this based on him doing master developments, right? So you go to downtown Vancouver and you get a big developer like Boza. And Boza's a big, great Italian developers, do a ton of high rises, have been doing it for 100 years. And so what do? They basically say we're going to put these number of towers with this number of units. And then what we're going to do is a ratio of the number of units based on the head count, we think, which are the people who are going to live in those units. We're going to put grocery stores and retail stores and fine dining. Well, it's a bit of a problem because what's happening in Vancouver, when you go up the Seaway and you look at 13 condominium towers, of which most of them are blanked out at night, and that's not because people are out there partying, because no one's in there. They're empty. And so what happens to the base of those towers? The base of those towers are food and beverage or retail applications. So the developers who are building those buildings are getting killed on the retail side of it. We're doing a very large grocery store at the corner of 17th and 14th in Alberta, which is like the middle of Bloor here in Toronto, or Robson in Vancouver. And we're sitting down at the largest grocery chain and we're asking about their numbers in Kirtland, in Vancouver. 30% below projections. Why? Because the head count isn't there. So that when it affects business, it inevitably affects politics. And when it affects politics roll back the provisions for these shadow market deals. And I don't know how it plays out, but it's going to play out in a way that this doesn't continue. And by the way, it's also happening in China. The Chinese government's sitting back there and saying, we are sick and tired of our Chinese money going down to North America. So I think they're going to get it from both ends. How it plays out, I have no idea, but it's going to play out and it's going to shift things.
Okay. Well, thank you very much. So just closing comments. So it's, really getting down to geopolitical, geography, knowing your demographics, knowing where the world's going, and, being on trend. So thank you very much. And I'm sure these gentlemen will answer lots of questions thereafter. Okay. Thank you.
Thanks, Angela. And I really want to thank Frank and Ali Khan for coming in. Ali Khan from Miami and Frank from Calgary, again, for traveling here to be here with us. So that was great, guys. And please feel free to speak to them further at the cocktail reception.